Welcome to the Level 1 Financial Reporting and Analysis Summary video series. These are the 14 readings in FRA, and we will go over a summary of all these readings. FRA represents 20% of your exam, which means that you will have 48 questions. In my opinion, the difficulty level of FRA is medium. There is a tremendous amount of material, and if you have some exposure to financial reporting, then it's not too bad. If you've never seen financial reporting before, then this would be difficult. The weight to difficulty ratio is high because the weight is the highest of any topic in the CFA Level 1 curriculum, and difficulty is medium, so the ratio is high. This means that FRA is perhaps the most important topic in your Level 1 curriculum. As I keep saying, this is a vast curriculum, so your emphasis at this stage should be on the core concepts and then just do tons of practice. This video is a summary of the reading on Financial Statement Analysis and Introduction. This slide shows you the major financial statements and some other information that you receive when you are studying a company. These are the major statements: the income statement, balance sheet, cash flow statement, and statement of changes in owner's equity. I will not say much on these here because we cover them later. Companies at the end of every quarter typically also release interim financial reports. These present the four major statements, but these particular interim reports are not audited. Companies also share proxy statements with shareholders. These proxy statements describe matters that are to be put up to a vote, and they contain other information such as management and director compensation, stock performance, potential conflicts of interest between management, board, and shareholders, and so on. In addition, when you look at the income statement or balance sheet or cash flow statement, there will be a tremendous amount of footnotes, especially with the income statement and balance sheet. In the footnotes, you can find information about accounting policies, assumptions, acquisitions and disposals, if any, and so on. So as a financial analyst, you have to carefully look at the footnotes. There is a segment called Management Discussion and Analysis, MD&A. This contains discussion and analysis regarding a company's future outlook and prospects. External audit and internal controls. A company's financial statements are often required to be audited or examined by an independent accounting firm. After examination, an audit report is published which must express one of the following. The report will say that the financial reports are unqualified, which means that there is reasonable assurance that financial statements are fairly presented, and as a financial analyst, this is what you want to see. Then the next level is qualified, some misstatements or exception to accounting standards, and finally the worst thing that can be stated is an adverse opinion, which means that the financial statements are materially misstated. Management should establish and maintain adequate internal controls over financial reporting. The objective is to provide reasonable assurance regarding the reliability of financial reporting. This particular slide shares the financial statement analysis framework recommended by the CFA Institute, and I will strongly encourage you to spend some time on this and at least learn the summary version of the framework presented right here. Step 1 is for you as an analyst to articulate the purpose and context based on your function, the client input, and the guidelines given by your organization. The output of step 1 is to create a document where you write down the objective, you write down the questions that will be answered based on this analysis, and the content that your final analysis will contain, the timeline for your analysis, and the budget. Then step 2 is that you collect data based on what has been described in step 1. You collect the relevant financial statements, other data, industry and economic data. You have discussions with the management of the company, maybe with suppliers, customers, competitors, and note down all this information. The output from step 2 is organized financial statements, financial tables that you might have created, completed questionnaires based on the interviews that you've conducted, and so on. This feeds step 3, which is called process the data, and essentially you are processing all the data that you have collected in step 2. Out of the process data step, you will produce adjusted financial statements, common size statements, ratios, graphs, forecasts, and so on. Step 4 then involves analyzing and interpreting the processed data and coming up with analytical results. In the real world, 3 and 4 are often happening together. Then we go to step 5, develop and communicate conclusions and recommendations. You create a report answering questions from phase 1, and this report will also have your conclusions and recommendations. And finally, follow-up means that you keep evaluating information and update your recommendation based on changes in the company or changes in the economic environment. If you found this lecture helpful, then I'll be very grateful if you can do 3 things for me. Number 1, like this video. Number 2, like my Facebook page. And number 3, visit analystforum.com and there add my logo to your studying with profile. You can see this slide for help on how to do that. Thank you very much and good luck with your studies.